Hello fellows, welcome to my channel. This channel is entirely dedicated and created for educational purposes only. Here you can find high quality educational materials to learn the basics, whether you are a beginner, more advanced or an intermediate trader. For people that want to see more action, you can check the link on the top right corner. Here we are proving our methods with real accounts. We trade for several years and we show that it can be done profitably. You can subscribe as all profits go to our subs. You can find all the details about our accounts. However, since you are new in trading, using real money is almost forbidden. Practice will make you better, and do not expect fancy cars and fake promises. Trading is real challenging and the numbers are against you. You won't need any money to start and everything is totally free. For most of our videos, you will find a link in the description that will lead you into a more advanced version of the video, but as beginners, I do not recommend. Stay with the basics and demo trading. So let's begin your journey. So what are pivot points and why are important? Not many traders use them and most new traders just follow some slappy patterns or try to find an easy way to trade the market. Well, that's why we are here. A pivot point is considered to be a technical analysis indicator, but it's not an actual indicator. It uses some calculations like the golden ratio we covered in previous episode. The pivot point is the average of the intraday high and low and the closing price from the previous day's trading. This creates a psychological barrier in the area of prices. The idea is simple again. Makes a bit more sense to try to calculate where the prices will go today based on yesterday's price action. So when you are checking any price, either you want to buy or sell, the first thing that will pop up in your mind is the question: what was the previous value of the asset I want to buy or sell? What were yesterday's prices, for example? What was the highest, the lowest, and finally where it closed? This average typical prices will give a better insight to help you evaluate future prices. This will give you a comparison number. Again, the game is psychological. Forget the prices. Now, stay with me. Advanced traders and market makers use pivot points to identify potential support and resistance levels, zones where the prices will jump or potentially jump, an area where there might be a change in direction. Pivot points are similar to golden ratio extensions and retracements. As part of a self-fulfilling prophecy, we need to pay attention to these levels. Pivot points are especially useful for the short term, and they are very useful as they give specific price. Again, nothing is perfect. It is another way to calculate support and resistances, and we will see several types of calculations for this one. Pivots are the areas that we expect the market to react. This helps us to trade breakouts and identify potential points where the market might reverse. Pivots are not in all platforms, but in any case you can download them easily. This is what you will see when you plot them. It seems a bit confusing, I know, but once you get the idea, you will see that it's very convenient to use. This is how pivot points will look in your chart. Now let's see how it is calculated. In this example, I have used a 1 week trading period, 5 trading days. The basic line you will see, the blue one, is the major pivot line. Simply calculated. It's the typical daily price. Open, high, lows divided by 3. Nothing more than the most important prices of the previous day. Now remember what we said about the typical price. I think it makes sense now why we use them most of the time in indicators. The next day, again, the same calculation, typical price and so on. This is our basic blue pivot line. In the basic pivot point, we will build support and resistances. These levels will create psychological barriers and what we should expect the next day. Now, let's continue. First, support and resistance level. How it is calculated? Multiply pivot points by 2 minus low for the first resistance, and for the first support, multiply pivot points by 2 minus high. Now, the second level of support and resistances. Resistance level 2, pivot point plus high minus low, and support level 2, pivot point minus high minus low. Notice the pairs that we are using. Now, the third level of support and resistance is high plus 2 times pivot points minus low, and the third support, low minus 2 times high minus pivot point. Now the question, why we use these numbers? Well, stay tight and you will see variations. You can find pivot points calculators, so you can put them on your chart manually. This is the easy part, but I think you got the idea. You know how support and resistances work, so you are good so far. Now let's see how to trade by using pivot points. Goes without saying that you should already know how to trade by using pivot points, but let's see more details. The simplest way to use pivot point levels is to use them just like you are using support and resistance levels. When the prices hit the first resistance or support, you should be ready. Again, there is no perfect way, I'm afraid. In this example, from what I can see, the prices respected the first level of resistance consecutively for the entire week. I'm noticing that we are in a trend, so this might be a good point to go long in the market. So what should I do next? I mean, we know pivot points are not perfect. Well, you are watching our series, so practically you know what to do. In these areas, we are expecting the prices to bounce. In this example, I can put my entry point at this point, my stop loss in the second resistance, and target the third resistance. Again, you already see how chaotic that can be. Well, I'm afraid this is how the market works. Now be smart when you are trading. One pivot signal is not enough. You should use them as major guidelines. Also, we said that you can use several take profit points. The market is unpredictable, but pivot points will help you to identify these profit taking points. Take your first profit, for example, in pivot point, and then try to follow your trade. Keep in mind that the market doesn't care about pivots. The wider the range of the previous day's candle, the wider support and resistance areas will be. The market will eventually pass through these prices, so just by adding some pivot points doesn't mean anything. As we progress in our series, you will notice that I am trying to use information to predict future prices. This will take some time to understand. Remember what we said. Everything is obvious after the market makes the move. The basic and the main idea when you are using pivot points is to identify future potential support and resistance levels. Again, as part of a self-fulfilling prophecy. Pivot points belong to the category of indicators that can predict future prices like the Gordon ratio, extensions and retracements. You need to use them as another confirmation signal. You can go back to the candlesticks formations and combine them with some technical patterns. Well, the more you learn in this series, the easier it will be for you to evolve as a trader. You already know that support and resistance are not always so solid. Pivot points will help you to trade breakouts. When the market consolidates in an area, it's ready to break out. But let's see how we can use pivot points. In this example, we have an area of consolidation. Notice this spike. Well, that day we had important news that moved the market and we had increased volatility. The prices indeed broke above in the first resistance, and I'm keeping an eye on previous support that it's in this area. The prices broke above and we had bullish engulfing candles. We enter long into the market and we will use the first level of pivot supports as our stop loss. Finally, the day closed in another area of consolidation. Now here comes the tricky part. What will be your profit taking target? Notice how beautifully the prices hit the maximum level of resistance, the level 3. But this might not have happened. Maybe the price started to reverse earlier and eventually lose your entire profits. If you have used a more defensive method by risking a 1-to-1, you would be out of the trade with a small profit, but you would regret that you didn't follow it all the way up. Well, this is a psychological part that will be a headache. When you are trading, a no regret policy is what you should adopt. Try to follow your trade and we will see how to do that in future episodes. Trying to take as much profit as possible is the key. You have several tools to do that and we will see more details in more advanced analysis we will use in this series. The fear of loss will make you put some really conservative targets in the beginning. You will have a roller coaster of emotion, especially when you are new traders. Excitement and disappointment will come in pairs. This will diminish in time. At these areas of consolidation, also an oscillator would be a very useful tool. This would help you to determine easier if the market is running out of steam or if the market is making a move. However, the price action will show you exactly what's happening. Pivots are not so popular among new traders. We can use pivots and the pivot points bound strategy. The main idea is to follow the main pivot points. This will reveal to you the market sentiment and what most traders are willing to do. The pivot line is a smooth average that will potentially determine future price. By using pivot point line as a super smooth average price can show you what the traders are most likely willing to do. In this example again we see that most traders believe that the prices will go higher. The prices stay above the basic pivot line. The way I use them is by plotting them on a weekly basis chart. This gives me an idea of how the prices will go. Again, our main focus is the base blue line. We know that by default Mondays are the days of the week that the market moves the less. We know that we have the peak of liquidity starting from Tuesday. This gives an insight on how the week will go. On Mondays the markets are always more cranky, depending on which side of the basic pivot line the prices tend to stay. This will give you the signal for the upcoming week. Of course, in theory, this is the way that eventually will end the week. Again, we compare that information day by day. We are making an estimation based on the basic line as we said. Again, in theory. What we are trying to achieve here is to know what and where most traders will look. This doesn't mean that the prices will behave the way we predict. Prices above the blue line is a buy signal and prices below the blue line is a sell signal. We have several types of pivot points calculations. The one we mentioned is called the classic pivot and several other variations that uses different calculation. Next, we have the Fibonacci pivot point. I guess you know why we use these numbers. In our calculations, we are using the golden ratio. The basic pivot line remains the same, high-low close divided by 3. And here are the changes. The idea is the same as most traders will use the golden ratio to calculate either extensions or retracements based on the swing high and low of previous days. Probably the most make sense values to use. In the future we will present some experimental indicators that use similar techniques. Next we have the Woody pivot point. Woody's pivot points approach gives more weight to the previous session's close compared to the standard pivot point strategy. The basic pivot point value is calculated slightly differently. The pivot point is high, low, and 2 times the close value divided by 4. Notice that we give more weight to the closing price because they have different formulas. Levels obtained through the Woody calculations are different from those gotten through the standard method. The main idea of using Woody's is that most traders give more weight to the closing price of the previous period. Another type is the Camarilla pivot point. The method was developed by Nick Scott, a very successful bond trader. Camarilla trading strategy systems are based on 4 levels of price resistances and 4 levels of price supports. The basic pivot calculation is still the same, high-low close divided by 3. The major changes are related to other levels. Notice how there is a multiplier similar to the golden ratio, but the idea is different. As we are starting to deviate and the prices expand, the multiplier becomes higher. The concept is that the prices tend to return to the mean. The more away from the mean, the higher the chances to return. This mean is the closing yesterday's price. Again, we give more emphasis on the closing price. This might give some strange readings. I know you might have some questions at this point, but we will see a deeper analysis in the future, so don't worry about that. Another less known method is the Mark pivot points. The Mark pivot points were designed by a trader, Tom DeMark, who has been famous for his innovative technical analyst trading techniques for decades. DeMark's pivot points are different from most others because they are conditional in nature, with an outcome that is based upon relationships between closing price and opening price. The Mark methods puts more weight on the close price. The trend lines are calculated and drawn from right to left instead of the traditional left to right. You won't see it very often and most likely you won't use it. The formula used in the calculation of the Tom DeMark is based on these conditions. If the close price is bigger, lower, or equal to open price. After we calculate the Z value, the pivot point will be that Z value divided by 4. This gives a more dynamic pivot point calculated value. Here we are using only one resistance and only one support level. The main idea is to understand what and how pivots can be used. Now the question is, what is the best? I'm afraid there is no holy grail. The golden ratio and the Camarilla, however, are the methods that make more sense to use. The Fibonacci is what most traders use, and you can use it if you notice a swing high or low. This will make the practical application easier. The Camarilla is also very useful as the prices start to deviate from the previous days. This creates conditions and a dynamic in the market. Now, remember what we said. More experienced traders will read the market differently. When an experienced trader sees the Camarilla levels to be violated, then it is a sign of a strong trend. I know that this is a huge pain, as most new traders prefer mechanistic rules. The key to successful trading is not picking the best indicator or the best pivot calculator and so on. Fibonacci and Camarilla tend to be the ones you will see more often. Again, thank you for watching. Go back, repeat the chapters you are not sure, and trade safe. So that's it for now. Thank you for watching our videos. I hope you enjoy. You know that we need your subscriptions, likes, and comments for the YouTube algorithm. Help us to make more content and trade safe.